mineral rights, real estate, kind of private credit, note investing. Like a lot of those spaces have just like been sleeping at the wheel. And we've been trying to get the message out that, guys, there is $16 trillion sitting in IRAs out there.
My name is Mike Mauceli, and this is the Energy Show with REI Energy, where we're energizing your investments and maximizing your tax deductions. Today, we're going to learn about mineral right investing opportunities, and you're going to discover how mineral rights offer specific benefits for anyone wishing to build wealth or protect wealth at any stage in life. My guest today is Mat Sorensen. Mat is a wealth lawyer and award-winning entrepreneur. He is the CEO of Directed IRA and Directed Trust Company. Great to have you on the show today, Mat.
Thanks, Mike. Excited to be here.
Well, I know you run a big company, and obviously you do a lot of work in the self-directed IRA space.
Yeah.
I think your company is one of the largest self-directed IRA companies out there, and so I just wanted to kind of talk a little bit to our listeners about self-directed IRAs and what type
Yeah.
of investments they can, that you can put into them.
Yeah. I mean, self-directed IRAs are essentially an IRA account that can invest in any asset allowed by law. A lot of people think of IRAs and 401ks, and they're thinking of stocks and mutual funds. They're thinking Wall Street, right? They're not thinking of real estate or mineral rights, oil and gas, private funds, startup, crypto. I mean, they're not thinking of any of those things. Those are investments people have heard of or may even have invested in. They've just never connected it with an IRA or 401k. And so what you can do, and this is like, this is the awesome news. If people don't know this, is your IRA or 401k does not just have to own Wall Street investments. You can invest in these other quote unquote alternative assets using your IRA or 401k.
So, for example, a company like ours that's in the oil and gas mineral space can
Yeah,
can investors invest in IRAs through an IRA?
absolutely. And so let's say, for example, you have, $100,000 at TD Ameritrade in a brokerage account and you're buying stocks or mutual funds with it. I mean, you could say, all right, I want to invest in a fund. I want to invest in, I'll take my, little sliver of this LLC that owns a bigger oil and gas play or some mineral rights. And I want to just go invest with them. I think that's going to perform better than the mutual fund. And so like, I think Mike and what he's got's going better than what XYZ mutual fund has. So, so they can move that money from the TD Ameritrade account, so to speak. But what happens though is if they call up TD Ameritrade and they're like, hey, I want to go invest in XYZ fund, TD Ameritrade is going to be like, well, you can't do that. And it's not because IRAs or 401ks can't invest in a private fund. It's that IRAs and 401ks at TD Ameritrade can't. Like they only let you buy publicly traded assets. That's their business. They're a broker dealer. That's what they sell. So they need to move their account, which is simply a transfer. So they would open up an account at a self-directed IRA custodian. Our company is Directed IRA. We're the number one, the best. There's 20 or other companies that do what we do, but you don't need to know who they are. So you open your account at Directed IRA, and then you just transfer that. So you like, well, I got 100,000. Maybe I'll move over 50, or you can move the whole 100. And it goes from a TD Ameritrade IRA to a Directed IRA account, Directed IRA. That's our company name. And now that quote unquote self-directed IRA, you can say, all right, I want to invest 50K into Mike's fund. And you'll have a subscription agreement, and you just fill that out as your IRA owning it, not you, your IRA is investing it. And
I
you
see.
would do that because you think that that investment's going to perform better than whatever you've been in before in the stock market.
So, say when you obviously make this investment, and are there any tax implications as far as owning mineral rights compared to real estate? Because I guess mineral rights are very close to real estate. They're both real property.
Right.
And but are there any tax ramifications when you make that move?
I mean, it's somewhat tax neutral, right? There are some
Right.
tax incentives investing in mineral rights personally, um, and that can help you now, right? You can get some tax deductions and tangible drilling cost stuff and things like that. That can help you on the personal side. When you think of your retirement account, I mean, the thing about your retirement account is it's a tax neutral account in the
I
sense
see.
that When you make money in it, you don't pay taxes, right? Everybody thinks of their IRA or 401k. It's invested in, you know, Apple stock, and Apple pays a dividend that goes to your IRA. You don't pay any tax, right? You sell your Apple stock for a gain that goes back in your IRA. You don't pay any tax. Well, that's the same thing for real estate or mineral rights, in the sense that I buy the investment and I don't pay taxes when I make the money, but I don't get that intangible drilling cost or any of those tax benefits for mineral rights. I'm not taking depreciation on real estate. So we're not doing the investing with our retirement account for any tax losses or things that might help us on our tax return today. We're doing it because you just don't pay tax when you make money in it. It's a different thing, right? Like, right. I make money in it. Let's say there's royalties paying out. Or let's say that the fund sells all the rights to a bigger operator or something. Well, that's either royalty income or capital gain income that goes back into my retirement account, and I'm not paying taxes. Now, there's some variations of there depending on fund structure and things like that, and debt and some things. But in a general sense, think of your retirement account doesn't pay tax. That's the benefit of using the retirement account. But I think when people are looking at their retirement account, and I think for me and just how I look at it, investing in mineral rights or other real estate is I'm really doing it because I think that investment's going to perform better than what I'm in the stock market.
So when you
That's
look
the
at
first and primary focus, I think.
Yeah. So when you look at a fund like ours or any other type of fund, mineral fund, I guess, you do have a point where you want to sell the assets. Say you keep them for 10 years and obviously it's created more value. Can you freely sell assets in an IRA, or how does that work?
Absolutely. And I think one of the things that we see is, I would just kind of generalize and say, quote unquote, private funds in general are actually the largest asset we have at Directed IRA. And more people invest in private funds, real estate, mineral rights than anything else. Surprising. I didn't know that would be the case. But and one of the reasons for that is, one, it's a little more passive for you, right? You don't have to go do your deal every day and go make money on your rental or worry about a tenant or something like that, or go find mineral rights yourself. You might not be in the business or understand that. So the funds are a great way for people to get in, but it's also a long-term play. When people are investing in their IRA or 401k, they're not looking to get back out of it in 6 months or a month, or they're not buying a second home or go on an expensive vacation or pay for their kids' college, right? This pot of money is long-term wealth building. So a 10-year window is sometimes what a private fund might go. It might go 5, 7, 10 years. And so most investors we see kind of stay in it through the fund cycle, and then they get out later because it's a long-term investment horizon. Now, if you need to sell before that, you could do that. The fund could offer a redemption, or you could sell to some other investor your interest. That's very common. We see that. So, but I think the nice thing about people with IRA or 401ks is when they're investing in private funds is they've already blocked this as long-term money. Let me just stay in it for the long haul. I'm not trying to get in and out of this, like maybe my brokerage account that I trade in, that I'm like, well, I'm going to buy a new car if the account does well, or this is going to the second house in a year or two or something.
How much capital is actually in IRAs around the country?
Yeah. The IRAs itself is like $16 trillion.
Wow.
If you add up 401ks and other retirement accounts, we're at $38 trillion right now. And so that 16 trillion that's just IRAs is actually the largest bucket now. A lot of people think all the money's in 401ks. Well, that's what it used to be. But what happens is people with 401ks, they've left their jobs, they've changed jobs, they've hit retirement age, and that money's been rolling over into IRAs over the last 20 years. And the IRA accounts of 16 trillion is primarily 401k or 403b or other pension plan rollovers to people's IRAs. And so people with an IRA can do immediately whatever they want, right? If you're like, well, I'm in the stock market, or I'm in a mutual fund that doesn't excite me, or I don't feel like the future is what I want it to be, and I'm like, I want to invest in a quote unquote alternative asset, I want to invest
Right.
in mineral rights, let's say, um, then they could move that money from the broker dealer IRA or the bank IRA, wherever their IRA account's at, to a self-directed IRA to go invest in it. But it's a huge market, and I really think it's an untapped market for anyone that's in that alternative asset space, right? I mean, the broker dealers, when they heard about IRAs, they were like all over it, right? I mean, when IRAs were first created, it wasn't just meant for publicly traded stocks and mutual funds. It's just that's the industry that went and dominated it and said, we will open up accounts for you. We will house your account so you can buy what we already sell. Like, Fidelity already sold mutual funds and stocks, right? Morgan Stanley already sold stocks and mutual funds, right? And then the insurance industry came in and said, hey, people are putting a lot of money in these IRAs. We should let people open IRAs with us. So then, like, New York Life offers IRAs, Northwestern Mutual offers IRAs. And what can you buy when you have an IRA account with them? An annuity, because that's what they sell, right? And so for whatever reason, I think even mineral rights, real estate, kind of private credit, note investing, like a lot of those spaces have just like been sleeping at the wheel. And we've been trying to get the message out that, guys, there is $16 trillion sitting in IRAs out there that can be invested into the deals and the investments you're doing. And if you're raising capital, make sure you're tapping into this money and having that conversation and bringing this content up amongst your investor base. And because on the other end of it, and we just see this on the other end, I mean, we're going to be in Dallas. Mike and I, he's speaking at our conference. And I mean, we'll have 200 plus self-directed investors there of people that are like, I don't want to buy another stock fund or mutual fund, right? They want to invest in alternative assets. There is huge demand for people who have IRAs or 401ks, this 16 trillion, that don't like what they're invested in and want to do something else, whether they want to diversify a piece of it or do the whole thing in something else that they believe in and feel more connected to. And so I think there's a win-win for everybody there. People that have investment opportunity off Wall Street, just in a general sense, and then people that have an IRA or 401k that haven't felt like Wall Street's delivered what they wanted, or they don't feel like they can be successful or have any competitive advantage. So it's a great place for people to, it's a great solution for each party to solve. The 16 trillion in IRA dollars, a lot of people have their little sliver of that, and then those out raising capital for off Wall Street type investing.
So when you look at alternative investments, a company like ours, I mean, we offer a product that is for investors that are looking for intangible drilling cost deductions. And then, of course, we offer a product which is just an oil and gas mineral product, which is good for IRAs. I always have a lot of investors ask me, well, can I invest in a drilling program with an IRA? And I always tell them that, you shouldn't, because obviously you're not going to get the intangible drilling cost deductions. It makes a lot more sense to buy minerals or something that is, that basically is a lot like real estate, that you don't have that drilling cost. I mean, your cost is free and clear, but also you potentially could be subject to UBITs if you're in a drilling program that has intangible drilling cost deductions. Can you kind of touch on that a little bit?
Yeah, and that's good. This is like, I think, for people getting into oil and gas, and there's a little bit of caveats here where you got to have a little sophistication. And that's why, like, working someone with like Mike, I think is important that you guys understand this and have a different offering set that kind of is more tax favorable for the different investor types, because your IRA is taxed differently and has different pros and cons than you individually. And so, and that was a great example I think you set up is, and not everyone does this, by the way, not every asset sponsor is thinking about this and from a fund structure standpoint, and where would an IRA investor rather be versus an individual investor, and how can we maximize the tax opportunity and still drive great returns for them. For an investor looking at intangible drilling costs, my preference would be similar to yours. Well, that's for the individuals. You get a better tax deduction on it. And, but for an IRA, since you don't get that, I go into that, I don't get that that tax benefit because there's nowhere for me to take it. IRAs don't pay tax, so getting a loss up front doesn't help me. But then the income that comes through, this is more of an active operation. That's why you get that intangible drilling cost deduction in the individual side. So for an IRA, I'm getting now more in just a general sense, active income from that investment, which can cause this tax UBIT, unrelated business income tax for my IRA. Versus instead, my IRA, and I think this is, and I would agree, this is if I was talking to someone as Mat Sorensen, the tax lawyer and wealth lawyer, which I don't advise clients anymore. I'm more running the business, but I would be saying use your IRA to go on the mineral rights side where there's more of a royalty or capital gain type income type play versus active income from and loss of the intangible drilling cost. Because over on that mineral rights side, I mean, there's no right. I mean, I don't know exactly your fund structure, Mike, but I presume there's no incentive for an individual from an intangible drilling cost to be on the mineral rights side.
No, not if you're, if you're looking for the intangible drilling cost deductions to offset some of your W-2 income. I mean, that makes a lot more sense. And plus, on the mineral side, of course, you're in the position of a landowner. So physically, you're buying interest from the landowner. So, these minerals are, you hold them for a lot longer. But, whenever a well gets drilled on the property, then you get income just as you would if you owned an apartment complex or something along those lines. You just get a check every month, which in my opinion, makes a lot more sense for people that are looking to invest their IRA funds.
Yeah, absolutely agree. And I think, and this is one thing for self-directed investors. I think it's you need to learn the different asset classes. And, we do an alternative asset summit too. We've had Mike's been there too. You guys have been at that event too. We're going to do another one in the fall. But the reason we do these different events is it does take a little bit of education. Like this stuff isn't in like the Wall Street Journal, so it's like, and it's not also like you just type in a ticker symbol to be like, all right, I want to invest in this. And let's compare it to the last 10 years and all of this, so but the learning curve is not huge. It's just, I like to tell people it's kind of like a board game. You just need to learn how to move the pieces, how things work. Once you've done it and played the game a few times, it's the same thing over and over. I mean, I give the same speech over and over and over on the different assets, and it's particularly with an IRA. I sound like a broken record, but so I don't want people to think that there's like, it's so complex. It's just new, like the board game you've never played. You just got to learn the rules a little bit and play it a couple of times, and then you got it down and we'll know, all right, when I'm using my IRA, I'm going to do this. And you could be also someone just like, well, I'm the business owner too. I mean, or the high income W-2 owner. I'm going to do a little thing different as I invest that money.
Yeah, no, it's good diversification, obviously, between the different asset classes. And, so there's different IRAs. I understand that. So a self-directed IRA, a Roth IRA, what is the difference between the different IRAs that are offered out there?
Yeah, I mean, you could have a traditional IRA or a Roth IRA, SEP IRA. A SEP IRA is essentially just a traditional IRA for a self-employed person. And so in general, there's kind of two buckets: traditional IRAs, Roth IRAs. In a traditional IRA, and this is the same for a traditional 401k, right? When you put your money into it, you got a deduction, right? Mm-hmm. You drop $5,000 in there in your IRA as a new contribution, or even in your traditional 401k, the IRS is like, great, take a $5,000 tax deduction. You made 100K that year, we're going to reduce your income like you made 95K for tax purposes. So it helped me now because I paid less tax. I had less taxable income in the year I put the money in. Now, the catch on the traditional is when you later take the money out at retirement and you start pulling on that money, you pay taxes, you draw the money out. I don't pay any taxes. I'm growing it, right? I'm investing it. I'm growing it. I'm getting returns. I'm not paying tax in the account as I grow it. But when I start pulling the money out at retirement on a traditional account, that is where I pay the tax. And that'd be the downside of the traditional. Helps me for tax planning as I'm getting my money in. It's reducing my taxable income. But the catch is I pay tax on the way out. The Roth is the exact opposite. I put $5,000 in my Roth IRA or Roth 401k. I don't get a deduction. The IRS is like, good for you, but if you made 100K and you put 5,000 bucks in, you still made 100K for taxes. You have 100K of taxable income. Now, when I invest my Roth account, I don't pay any taxes. I'm growing it just like the traditional. But the perk of the Roth and why we actually have more Roth accounts than any other account type is when you pull the money out of the Roth account at retirement, there's no tax at all. So a lot of people look at it and say, hey, I might put $100,000 into my IRA over 20 years, but if I get that account to $1 million, which is possible over a 20, 30-year investment horizon, very possible, and it's not getting ridiculous returns. When as I pull $1 million out, I don't pay any tax. So I had to pay the tax on the 100,000 of income that I contributed over the years into it, but I get the benefit of not paying any tax on the gain as it's growing and when it comes out. So a lot of people say, I'd rather pay tax on the seed than on the harvest. And that's the principle of the Roth account. There's differences of opinions on it. The Roth doesn't always win over the traditional, but for our investors, we definitely see more Roth accounts, but we certainly have a ton of traditional dollars too.
So a self-directed IRA, say it's coming out of their traditional IRA, right? And you're setting up a self-directed IRA so you can invest in real estate, oil and gas, minerals, whatever that asset is that you want. Do they pull all of their money out of their traditional and move it to a self-directed, or do they just pull a portion out of it that they want to invest in one of these alternative assets?
You can do either one, whatever you want to do. So if you've got that traditional IRA at Fidelity, let's say, and you're like, well, I want to invest in REI Energy's fund. Okay, you would move that IRA from Fidelity, that traditional IRA, to a traditional IRA at directed IRA. And then that could be the whole account. That could be 50K, 100K, whatever the investment amount you're designating. And then that traditional IRA would then go make the investment into the fund and it owns the asset, right? And so that's in a sense there's a couple points in the middle there, but that's the outcome of it is. And if it was a Roth account at Vanguard and you move it over the whole thing or a portion of it, it's now just a Roth IRA at directed IRA, and then you go invest it from there.
So if an investor, decides, because I've had investors tell me before that they would just, pull money out of their IRA and make an investment. I mean, that's not really a wise thing to do, is it? I mean, as far as that,
that is so dumb because, and we see it every once in a while. There's always like a tax court case every year if someone did that and thought they were self-directing. And so they pulled the money out and they thought it was still in their IRA and it got sent, it was actually distributed. So yeah, that make sure you don't get confused on that. And sometimes it's the place you're working with. I mean, sometimes you're calling up your IRA administrator and it's some broker dealer and you don't have the smartest person on the phone and they do the wrong thing because you don't know what you're doing. And I hate to say it, it happens. So the important thing to think about when you're going to do this is you need an IRA custodian. So that's what directed IRA is. We're the custodian of your IRA. We qualify it for tax purposes. We send the IRS something every year that says this account is an IRA. It still qualifies and we hold it. It's the same thing TD Ameritrade does or Fidelity does or Morgan Stanley does or Vanguard does. They do the same thing. The problem is they put a restriction on their accounts to say publicly traded assets only. When you're a directed IRA, it's still a retirement account. There's no distribution, but we're not going to put a fence around you and say only buy publicly traded. We'll let you invest in mineral rights. Like that's an option with your IRA here. So make sure that you're just moving the account, and it's called a transfer or sometimes a rollover. Don't do a distribution. If you're touching any form that says distribution, you got the wrong form from your IRA provider.
So what is the year that investors can start pulling money out of their IRAs? How old do they have to be? Is that 65 or
59 and a half? So 59 and a half is the age when you can start pulling money out of your retirement account with no penalty. If you try to start pulling money out of your IRA or 401k before 59 and a half, you have a 10% penalty to get the money out early. It's the early withdrawal penalty. So this is why I generally like to think of it as long-term wealth building, Now you might be in your 50s and you're like, that's right around the corner for me. I'm not, some people, in their 30s or 40s, you should always think of your IRA or 401k, and most people already do, but just think of it as your long-term wealth building money. It's not your short-term money. So, but you do get to tap it at 59 and a half. And then there's no penalty at that point. And as you're pulling money out of the Roth at that point, there's zero tax as you're drawing the money out of the Roth. Then as you're pulling money out of the traditional, once you hit 59 and a half, it falls into your taxable income. So just, you want to keep that in mind of, do I need the money or not? And frankly, what a lot of our clients do, I mean, we have a lot of clients in their 60s and 70s that do pull money out of their IRA that are traditional dollars, is they're strategic when they pull it. They're like, I'm not going to pull it unless I have to. I'll live off of the other income I've got. And so this is kind of their last bucket to pull from, because they really want to reduce any like wage income or any of their other income. So they're in a low tax bracket when they do start drawing out of the traditional. So there can be some strategic tax planning on the back end of how you access that. Because, up to $50,000 of income in retirement, you're really not paying any federal income tax, Yeah. But if you have still a great income, you own a business, you have other rental real estate income that's taxable, or, some people, even at retirement, they sold their business, or they don't have that W-2 job anymore. They can still have some income that can keep them in a higher bracket. So I don't know, there's some income tax planning you can do there to try to minimize your burden, of course, on taxes.
So you're not penalized at 59 if you don't pull the money out. Is that what you're saying?
No. Okay. Yeah. There's no requirement to pull money out. So once you hit age 73 for traditional IRAs and 401ks, the IRS wants you to start pulling money out, because in traditional accounts, the IRS is like, dude, we gave you a deduction to put this money in. You didn't pay taxes as you grew it, but you have to start eventually pulling this money out. You can't just hold out forever and pay
we want our
tax.
share, right?
Exactly. Like, Uncle Sam's got their hand out. Like, come on, you owe us some money. So in traditional accounts, they know, the IRS knows, when you pull that out, you got to pay the bill. You got to pay the tax bill. So when you're at age 73, and that's the age right now, it adjusts for cost, for average lifespan. But right now it's age 73. So when you hit that, you do have to start pulling money out of your traditional IRA or 401k, but it's maybe 4%. So if you have a $100,000 account, you're taking out $4,000. You got $1 million account, you're taking $40K a year out. And it slowly goes up as you get older, to maybe about 10 or 12% max that you have to start pulling out. So it's not a lot that you got to pull, but it is something to think about if you're kind of in your 60s or approaching that age with a traditional account. Now, with a Roth account, when you hit age 73, there's no required minimum distribution at all. Now, if you think about the Roth account, right, as I explained earlier, you don't pay tax when you pull the money out in a Roth account. And because you don't pay tax when you pull the money out, the IRS doesn't make you take the money out because they don't get paid either. So they're like, right, they're like, keep investing it if you want. So you can take it if you want, right, at 59 and a half. But when you hit 73, there's no requirement that you start taking out some of it like there is in traditional accounts.
That's pretty interesting. Well, I know there's a big show coming up this week, the Self-Directed IRA Summit, and thank you for inviting me to be there. I'm looking forward to it, and if our listeners want to attend, it's going to be in Dallas, right?
Absolutely, it'll be in Dallas, April 20th. And if you can't attend live, which I'd love the live, because you're going to meet all the cool people and network and see the other people that are self-directing their account that have been doing this. Like, I have a number of account owners that are there that'll be speaking. Some of them have seven-figure, million, tens of $1 million in their self-directed retirement accounts that have been very successful. And I'll have some people starting out. We got some other great experts in different asset classes like Mike. And but we kind of go over the rules, what you need to know, how you do it, what we've seen people do that have been successful. You can also attend virtually if you don't want to get to Dallas, but it's sdirasummit.com, sdirasummit.com. And it's a heck of a good time. We'll have a rock band after. So it'll be a good time.
Well, I know I'm looking forward to it, and I've been telling a lot of my clients about it, so hopefully some of them will attend also. But
excellent.
Anyway, if you're in town, stop by, and you'll learn a lot about IRAs. Matt, it was great having you on the show today. Thank you.
Thanks, Mike. My pleasure.
This podcast is a presentation of Rich Dad Media Network.